Good afternoon, everyone. JR with Secure Metals, bringing you your technical analysis here for both gold and silver. Today is Wednesday, January 22nd, 2014. This is the first video of the year. Not the best year for gold here, 2013. We're expecting 2014, obviously, for things to turn around. The technicals, the fundamentals are all lining up. I think this year is going to be a much better year than it was last year. At any rate, I have some really good patterns building here. I wanted to point this out. Again, first video of the year. And I wanted to wish everyone a happy belated New Year's. I hope everyone had a terrific holiday season. At any rate, let's get to it. Daily chart here on silver. Silver building a very, very nice bullish pattern. If you remember here back in June, we traded sideways here between, I would probably say between the end of June all the way up to roughly around the beginning of August. So roughly about 2 months of a sideways trading, and then we saw a big move to the upside. Again, remember, the longer we trade sideways, the bigger the move to in whichever direction. So if it breaks up, if you have a breakout, obviously we look for a big move to the upside. If it's a breakdown, of course, we would look for a big move to the downside. And I see here that we are building a very similar pattern here. Let's put some... So we can see here we're building a very, very similar pattern here, where you had some sideways consolidation, you had some big bullish candles here. These are called engulfing candles. Anytime you see a candle that that engulfs the previous candle, that's called an engulfing candle, usually very bullish. And again, you can make bets towards the upside with a limited downside here. So I see a nice engulfing candle here. We ended up moving sideways here for about a month and a half or so, and then you had a big move to the upside. I see the same thing happening here in the in this side here, where we see a nice bullish engulfing candle here, engulfing this previous candle. We had some big moves to the upside, and again, they turned out to just be flat. So again, still trading sideways as of now. This is your range, okay? A little bit higher range than we had previous, which is good, means we did not create a lower low. Still have this long-term trend line trying to push us back down here. But again, at this point, we want to see if this is going to break to the upside. I think if it does break to the upside, which again, it's made several attempts, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I mean, you have about 12 attempts, and the more you test a level, the odds of that level breaking gets much better. So again, plenty of attempts to go higher, and if it's the case that we are going to go higher, again, you have some nice bullish engulfing candles here, and again, we would look to surpass this long-term trend. And if we do, I suspect that the minimum move that we'll see is up to 22.27. This would be your first stop around the 180 moving average. Previous support now turned resistance, roughly at around 21.12. We call that a soft resistant point. And again, this would be the next level, 22.29. And of course, if we can surpass this level here, then we would look for another soft support at around 23 even. And of course, this is where you're going to have your heavy resistance. I'm sorry, I didn't mean to say support. I meant to say resistance here. And of course, more resistance over here at around the 24.5 range. So at this point, I like the patterns that we're building, very similar to the previous pattern. And again, stochastic still pointing lower. We had a big bearish engulfing candle here, so we might do the same thing we did here, which is again come down, pick up some momentum, and then really push higher. Okay, so I really like this silver chart, but again, we want to surpass this level here. Of course, good time to get in right now. Anytime you get in between $19.50 and $20, whether you're looking for a short term or a long term, I think I think the downside is very limited. Again, we can clearly see here that this is still a very bullish chart. We've had a huge correction. Again, what I said earlier, the longer we trade sideways, the bigger the move to whatever direction. And we can clearly see this here, where we really just traded sideways here for almost 2 years, and then we had a big move to the downside. Now, again, silver trading at its lows, $18, $19. I think it's a steal if you ask me. Long term, you should find some support here on this weekly candle. This weekly chart doesn't look all that great because your 20-day moving average is pointing down. But again, you have a nice bullish candle here and another nice bullish candle here. These are your signals to get in. It basically means that the buyers are coming. But at this point, it's really just a matter of waiting. I think regardless, I think you buy here, your downside is limited, and I think your upside is at least $26. So if you do the math, you're at $19.85. You can get in at around $20. You have a $3 to $4 downside risk, and of course your upside risk is roughly $6. I like those odds. Okay, and of course continue to accumulate. We're still printing $75 billion, still adding over almost $1 trillion a year to the Fed's balance sheet, which is now at $4 trillion. So again, nothing really positive about anything currently going on, and this whole bearish sentiment here, if you ask me, is really just market manipulation. But again, I could be wrong. Again, I do believe we will see some newer highs here, not newer highs, but I do see some short-term highs at least 22 and a half, and hopefully we'll be looking to test the 38% fib level here from this high, from the high of October 2012. As far as gold goes, let's look at the gold chart. Gold chart, again, building a very familiar scenario, very similar to the one that we saw back in June of, what was it, June of 2013. Let's get some objects here, and of course this is your this is again building a very similar base to what we saw. We saw a quick move to the downside and obviously a quick move to the upside. This could be a fake breakdown, and if that's the case, of course you're seeing this move come together now, where again you have the fake breakdown, and of course usually false moves usually equal to fast moves in the opposite direction. So again, we're looking to retest this 1260, which we did just a couple of days ago, and at this point we want to see how this is going to play out. 20-day and 50-day moving average are both below us. That's fairly positive. If we can find some support here between 1232, 1234, 1235, I think we can go higher. As long as we stay, I think, above 1215, I think we should be good. Okay, and that's your gold chart. Let's look at the Dow Jones briefly here. Dow Jones, again, 50, I believe it was 50 all-time highs that we saw last year. And again, based on cities going bankrupt and current economic fundamentals, does it really make sense that this Dow Jones is this high? I don't know. I think you should be the judge of that. But in the same respects, I do warn everyone, I do think that the Dow Jones will continue to go higher here in the next coming years, but I would expect a decent correction, at least back down to the mid 15,000s. And again, I would wait for that. But again, this huge broadening formation, which I've talked about a few times, is still intact. And just because we go a bit over, it doesn't mean that it's no longer a threat. I would be very, very careful, because at this point, you know, the way you have to look at it is the odds of this thing going, you know, to 17,000 or 18,000 or 20,000 are probably just as good as this thing coming down all the way to, you know, 14,000 or maybe even 12,000. This hasn't seen a correction This thing hasn't seen a correction here since 2009. We did see a decent correction here where we moved down 16%, but that's within a 3-year, 4-year span, you're getting a 1%. You're getting a one-time 16% correction. I just don't think that's strong enough. I would like to see another correction here, but again, I just wanted to bring those good technical levels here for you guys. I want to play this video here that I have. It's only a 6-minute video, so if you have time, please watch this video. It talks about the truth of central banking in the business cycle. Please pay attention carefully. It does a great job of explaining how central banks work the currencies and how destructive this can be to an economy. All right, guys, thanks for joining, and we will see you next time. Have a great one. Bye-bye.
The truth about central banking and business cycles. Pretty much every country on the planet has a central bank, and they are causing more harm than good. For some reason, the topic of banking is shrouded in confusion and mystery. It doesn't need to be. Banks provide an essential service in market economies, and when governments create a central bank, it throws a wrench into everything. To understand the problems with central banking, we first need to understand what banks are supposed to do in a free market. Simply put, banks coordinate people's plans, the plans of savers and consumers. As we already know, when somebody saves their money in a bank, it becomes available for an entrepreneur to borrow. But banking isn't just about paper changing hands. We've got to dig a little deeper. That money represents something, the ability to consume goods and services. When you have $1, you have the ability to purchase a candy bar. When you don't, you don't. Here's what that means. When somebody saves money at a bank, they're choosing to forego their consumption and allow somebody else to consume in their place. Why is this coordination important? Because at any given time, there are only a certain amount of goods and services in the economy. And if our plans aren't coordinated, there's no way to know what projects we're able to undertake. Turns out, which projects entrepreneurs start is strongly influenced by the interest rate, how expensive it is to borrow money. In a free market, interest rates are determined by the balance between savers and consumers. The more people save, the more funds become available to lend, and the lower the interest rate. The less people save, the less funds available to lend, and the higher the interest rate. When credit's expensive, only the safest projects get funded. When credit's cheap, entrepreneurs can start longer-term or riskier projects. But remember, banking isn't just about paper changing hands. When a developer needs money to construct a building, it's not the paper that he needs. It's what the paper represents. Goods and services to consume in the short term. After all, it takes many different goods to construct a building, not just concrete and steel. It also takes food, shelter, cars, clothing, health services, and many other goods and services for the employees. Construction workers obviously don't get paid in food or clothing. They get money. But that money represents all the goods and services which can be purchased with it. So here's the key. When someone saves their money, which means they don't consume a good or service, they are making it possible for other people to consume with their money while undertaking projects, like the construction worker who demands goods and services while he works. Now, this works fine and dandy within a free market, but we don't have a free market. Instead, this precise system gets turned on its head when governments intervene. Remember that interest rate? Well, when central banks meddle with it, it no longer represents the true relationship between savers and consumers. In fact, central banks often intentionally lower the interest rate to help stimulate the economy, How do they do this? By creating new money to inject into the economy. And sure enough, when the interest rate is artificially low, the economy tends to boom. Banks lend more as businesses undertake new and longer-term projects as they expand. Unfortunately, many of these loans turn out to be bad investments, and this boom is destined to bust from the start. Here's why. Instead of what happens in a free market, where one person's savings is another's consumption, loans not backed by savings result in both parties trying to consume at the same time. Legendary economist Ludwig von Mises called this overconsumption, and it leads to all kinds of problems. For example, if a bricklayer thinks he has 10,000 bricks and starts a new construction project, but he really only has 1,000 bricks, he is destined to fail, and there will be an inevitable bust as he runs out of bricks. This is what happens when central banks artificially lower interest rates. Too many loans are given relative to the amount of real savings in the economy, and those extra projects are doomed to fail from the beginning. Once economies go into a slump after these artificial booms, there's only one cure: a bust. All those doomed projects have to go belly up, and the bad loans have to be liquidated. Unfortunately, central banks don't like to let this happen. Instead, they usually try to create more money and lower interest rates even further. This just adds fuel to the fire and makes the crash that much worse. Think about it. If all we needed to be wealthy was paper with numbers on it, we could solve everyone's economic problems just by turning on a printing press. But governments have been trying that throughout history. It doesn't work. Most countries now have central banks, but the economic principles remain the same. We'd all be better off if the delicate dance between savers and consumers remained free from the meddling of central banks. To learn more about sound economics, visit fee.org.